Hi, everyone. I'm Rick Bensignor, and this is our weekly In the Know Trader webcast. Today, we'll continue in our discussion of Tom DeMark's sequential model. This indicator, only available on Bloomberg and the CQG platforms, is one of the favorite models used by trading-oriented mutual funds and hedge funds to help indicate when it's generally a pretty bad time to be putting money to work in the direction of the current trend. Some people have taken that to mean, well, if it's a bad time to play the trend, it's a signal to play against the trend. That may or may not be true, but the model was actually designed to indicate when it's a lousy time to be a buyer in an uptrend or a seller in a downtrend. So we'll discuss some of its uses and look at also some of its sister models and the differences between them, because there are several offshoots to Sequential that people use also on the institutional side. And to finish off the half hour that we'll spend together today, I'll take a look at the S&P and the dollar index chart and kind of give you my thoughts on those, considering how important right now those two markets are to, I think, pretty much everything else going on in the world. To start off, though, I want to remind you that I'll be speaking at the New York City Traders Expo in March. The event runs from March 10th to March 12th, and I'll be doing a rare public presentation on how to properly use the Ichimoku Cloud Chart indicator on the afternoon of March 12th. Registration for the event is free. Again, it's being held in New York City. Here is a link to sign up on. So if you go to rickbensignor.newyorktradersexpo.com, you can find out more information. And again, sign up. This is one of the conferences run by the parent company, The Money Show. It is a terrific event, and you can attend virtually all of this event for free. There are a few paid master classes, but otherwise you can spend truly an entire day from 9 till 5 o'clock or so, each one of the 3 days, sitting in and learning some great information from lots of people on Wall Street who have presentations to make for you. So once again, I'll be speaking on I think it's Tuesday, March 12th, late in the afternoon, and doing one of the very few times that I will make a public presentation on how to use cloud charts. Otherwise, I typically reserve that for institutional clients. Turning to, let's say, the educational portion of today's show, this is going to be our fourth and probably the last installment on the use of the sequential model that Tom DeMark developed. Again, this model was developed back in the 1970s and has been minimally tweaked since then. So it's a darn robust model. And we'll kind of finish up looking at how it's intended to be used, how and why I incorporated it into In the Know Traders weekly newsletter that my subscribers receive, and how valuable it can be at calling market turns as they actually occur, as compared to, well, after the fact, the way most other traditional technical models give you clues for turns. So this, as I've said over the last couple of weeks, this is the single best model I know of that can actually call the turns at the peak or the trough of a move, rather than anywhere from 10 to 20% above the bottom or beneath the top before you first get, let's say, a moving average crossover or a head and shoulders top that finally breaks down. This is designed to look for the extreme point of a move and help identify it. So let's start off by taking a look here at the chart of TNX. TNX, of course, is the index that essentially replicates the U.S. Treasury 10-year yield. The only difference here is that the decimal place is off. So at the current price of 26.47, that's essentially the equivalent of 2.647% in the 10-year. All right, so all they've done is moved the decimal over. This is not a tradable index in the sense of like an ETF. You cannot buy this at 26.47. It is simply showing you what the 10-year is trading at. There are, I believe, options on this, but it is not designed as a stock or an ETF that you can purely trade this. Of course, you can trade 10-year Treasury futures if you're a futures trader. And the closest ETF I know of that's liquid and the street kind of looks at to trade this is the ticker symbol IEF. It's an ETF that is designed to track the Lehman 7 to 10-year Treasury index. So that is about as close as you can get to the actual 10-year. Many people trade, I'm trying to remember, I think it's TLT, which may even be more liquid than IEF, but TLT tracks the Lehman 20-year bond index, and therefore it really could be trading differently than the 10-year. So, for people who want to trade it, look at the IEF, but I'll often do the analysis on the TNX chart itself to tell me which way to play the bonds, and then I'll also see if IEF is, let's say, confirming it, or I'm getting the same type signals in futures. Of course, futures would be an opposite signal in the sense that here we're looking at yield and futures trade in price. So a buy signal here would be the equivalent of a sell signal in the futures markets. Nonetheless, I wanted to show you, again, kind of get a little deeper into the sequential model here and some of the signals it's given in the bond market over the last year or so. So we're looking at a 1-year daily chart, and you can see it kind of smack or darn close to smack in the middle of the screen. I'll highlight it here just to make it stand out more easily. This is a sequential buy signal. I'm going to zone in here and kind of blow this up so it's easier to say. And here, let's take off, let's say RSI, let's even take off MACD so we have the full use of the screen. So this 13, notice again, the numbers are coming underneath the price bars. So this is looking for exhaustion of downtrend. The trend started back in here when we did a 9 count called the setup. That was 9 consecutive price bars. In this case, it's a daily chart, so 9 consecutive trading sessions that the closing price was less than the close from 4 bars earlier. After you do this, you have the first piece of this model saying you've at least moved enough in one direction to say there's potentially trend here. Ultimately, the software will look to define the exhaustion point of the trend, which in this case is 13 times. They need not be consecutive price bars, whereas the 9 count has to be 9 days or 9 weeks in a row that the close is less than the close from 4 bars earlier. Or if the market was moving up, let's say it was here, this is a pattern of 9 consecutive price bars that the close, each one of these closes is higher than the close from 4 bars prior. When you move to a 9 count and have completed a setup, you've at least moved enough to indicate that there's enough directional movement to potentially say there's further trend to come. Sometimes that doesn't happen, and we see 9 counts themselves kind of top a market. This one kind of bottomed the market. We rallied a little. We did another 9 count. We'll get to this in a second. But this 13 count in here, which is the countdown portion following the setup portion, is what's looking ultimately for the exhaustion point to the trend. And once you do the 9 count, the software will then subsequently look for closes that are lower than the low from 2 bars back. So this bar here with a red number 1 underneath it indicated that this close was less than the low from 2 bars back. Notice this day here, this day here, this day here, none of these have red numbers underneath them because none of their daily closes was beneath the low from 2 bars back. So the model just waits until you get a subsequent time that the close is less than the low from 2 bars back. And that's why this became bar 2. This is bar 3, and so on. It does not count this bar as a close less than the close 2 bars back, so it did not get a red 4. But while we're looking for exhaustion of this trend, we happen to notice that another setup is forming. And so even though this bar here labeled 3 in blue is not part of the countdown, it's not a red count because its close was not less than the low 2 bars back. You'll notice the close was slightly above the low from 2 bars back, but it did close less than the close from 4 bars back, and therefore this is part of a new setup. So while we're trying to exhaust this trend that all started from this 9 count here, we're actually getting another 9 count. And this second setup is entitled to its own full 13 count in order to find the exhaustion point to this setup. But as I had said last week, there are 2 rules to cancel when a setup will stop looking for its exhaustion point. And that is if you have a full day's price action that's low is above the highest high in that 9 count. And in this case, the highest high in this 9 count actually came the close of the bar before bar 1. So it takes the true close as compared to the actual close if there's been a gap. So because bar 1 gapped lower, it's saying the close here is the high of this 9 count. It throws this line out here telling us that that's the reference point, the highest high in the most recent 9 count. And this line still acts as potential resistance and still lets this 9 count get a 13 count, or at least a move towards a 13 count, until and if you get not just a simple close above that blue line, but an entire day's range above it, which happened in this day. And here, it's probably darn close. Nonetheless, the line stopped drawing, indicating that we're no longer looking for exhaustion to this 9 count, and we've already seen this 13 count come and exhaust the move that started with this down count. I know it's a lot to follow, but if you've followed along the last few weeks with us, you should have a pretty good feel for this. By the way, the 13th bar has its own rule, and it can either open or close beneath the low from 2 bars back to qualify as a 13. All the other counts in the countdown, the red counts, all need to close less than the low from 2 bars back in a countdown that's trading lower and looking for exhaustion of the trend. So right here in the middle of July last summer, this indicator is saying we've exhausted the downtrend that started all the way with bar 1 back here in late May, and that at the very least, playing in the direction of the trend is a high-risk idea. And when DeMark created this model in the 1970s, it was designed to identify when the risks were really high to add to shorts in a downtrend or add to longs in an uptrend. As time went on, some people who, especially as hedge funds became more prominent into the 1980s and 90s, they often looked at this signal and thought, if it's a lousy idea to be a seller in a downtrend, then maybe it's not so bad to be a buyer and look to play for a counter trend move. And I'll tell you that most people who use this model think in those terms. So the institutional community looks at these signals as really being counter trend signals. And as I've said, I don't know any model that works as well as this to actually find the turning point to a trend, but it's not truly designed to be that. It's truly designed to say there's a lot of risk to sell and put new capital to work, being bearish, essentially further shorting this move. So again, some people say, well, if it's a lousy short, maybe it's a good buy. And sure enough, a lot of times you see significant reactions off of sequential full 13 counts. And this kind of called the bottom to the day, and it never traded lower, at least not for another month or so. So we moved up, which would have been a decent trade. There's some other here. Let me take propulsion. There's some other models here I'm running, and I'll try to minimize this simply to sequential. Eventually, we do a 9 down. 9 down says we've moved enough to potentially and to allow the software to start counting towards the 13. We really didn't progress much beneath this 9 down before it turns around and does a 9 up. And if it does a 9 up before 13 is complete, that also cancels the software from looking for a 13. So in real time, let's say this bar here actually had a red number 1 underneath it because its close was less than the low from 2 bars back. Even though this was an up close, the close was just barely beneath the low from 2 bars back, and this would have been day 2. And let's see, this would not have been day 3 because the close was above the low. This would have been day 4. But eventually we did a 9 up here. So this 9 here dropped off any red numbers that were still active at the time because now we've moved in the opposite direction. This 9 count is entitled to now look for a continuation of a potential up move. The up move comes, the software's counting. Notice that this is a pretty strong trend, but there are certain days that did not make this count consecutive. And again, the countdown portion, the red portion, does not need to be consecutive bars. And I actually, in fact, if you do a 9 count followed immediately by a 13 count in consecutive price bars, I often would not take the 13 signal. I would tell you that there's just too much strength in one direction that I tend not to take the signal. Here into October of last year, we get an exhaustion point on this 13. Again, that said, it's really bad time to be a buyer. And again, a lot of people take that, well, if it's a bad time to be a buyer, it's probably a good time to be a seller. We sell off for a couple weeks. We come back, we test the high. This, if you recall, in yield terms, was the double top at 3.25% in the 10-year last fall. And then the market starts selling off. We do a 9 count. We pause for a couple of days off of the 9 count and then start trading lower. We start here the countdown to the downside. Notice that while it's counting down, it's also started a new setup. So again, even this 9 count is entitled to its own 13. We get down to this 13 here. It's saying exhaustion point to the 9 count up here. But we also have another active 9 count. So it would be very aggressive to just jump on this one and potentially say that's all there is. I would, at a minimum, wait for a price flip up. A price flip up is a close, in this case of a downward market, a close above the close from 4 days back. In other words, a blue number 1 coming on top of price bars. We plunk down into the early part of 2019. This was the second day of the trading year, right? So January 2nd this year, first day of the trading year. We're still trading lower. We have the big move down. We've now filled 2 unfilled gaps that had gone all the way back in time from early 2018 where we had unfilled gaps. So now we've filled both gaps. We got a significant rally, but we haven't finished out the 13 count. And then kind of at the very end of January, you finally get a 13 saying, all right, we've got exhaustion of trend. And you got a quick bounce from that, and yet we're still not really getting a major counter trend move that you would hope for off of this signal. Now, one of the things that we haven't talked about yet is when do you know that the 13 signal that's indicating potential counter trend move is wrong? In other words, how do you get stopped out of one of these signals? And the calculation often comes off of because there's an automatic stop level that gets calculated. It's all the way down here, 2.447%, or 24.47 in TNX terms. During the 13 count, the software will look for the bar that made the lowest low of the down move. In this case, it was bar 10. It'll take the true range of bar 10. So in this case, it was a slight gap. So it's going to take bar 9's close, measure it down to the low of bar 10, take that distance and kind of remove it from itself, take away that same amount from itself, and that's where the stop out level is. So if you were going to play this 13 and kind of, let's say if you could actually buy the TNX at 2.62, you would have to risk all the way down to 2.44, 2.45 or so before you get stopped out. To me, that's probably too large a risk to buy something here. So in something like this, it's a trade I might simply not take, even though the model suggests you do. And to me, risk management is first and foremost. And if I've got to risk this much, I probably don't take the trade. So that's kind of a look again and a picture of sequential. But one of the things I also mentioned at the start of this is I also want to show you some sister models to sequential. So this is with standard sequential settings. There's also a setting called aggressive sequential. An aggressive sequential counts similarly, but not the same way. The 9 count in blue, the setup count, is still the same. If a market's moving up, it's 9 consecutive price bars that the close is above the close from 4 bars earlier, then followed by 13 bars. But instead of 13 bars, that the close needs to be above the high from 2 bars back. An aggressive sequential count simply measures or compares the close versus the close 2 bars back, not the close versus the high, the close versus the close. In other words, it's more lax, it's more aggressive. You're going to get your signals often faster, and you can see this 13 here that I'm circling with my mouse came in faster than the traditional sequential 13. There are times, and I'll tell you, like in 2018, that aggressive sequentials work better, for instance, in the S&P than a standard sequential. So one of the things I've learned over time is to kind of take a look back historically and see which of the two tends to catch the mode of the market better. You don't always get a perfect answer, but here, as we bring this together again, this 13 here, and let me highlight it to make it easier to say, this 13 right here, I use different colors so I know which sequential I'm looking at, is an aggressive sequential finishing off this 9 count. But again, we did another 9 count, and then that actually gets its own count. And the day that made the lowest low for this move, which was January 3rd, says exhaustion of downtrend, yields are not likely going lower. They'll probably head higher, which is what they've done. So notice the difference between here. Let's use a rectangle to highlight the difference. This 13 here finished off that 9, whereas this 13 here in yellow finished off that 9. Again, the aggressive one came in sooner. On this second setup down, that doesn't finish until that standard setting, but the aggressive sequential actually caught the exact low. And again, think about how long you've been in this industry and how many times you've come across models that can call literally to the day or darn close to it the exact turn of a move. So this is an institutional-oriented model. Again, it is not available on StockCharts. It is available on 2 platforms only, Bloomberg, so you need to be a Bloomberg subscriber, which goes for about $20,000 a year before the extra $500 or $600 a month that this costs on top And it's on the CQG platform, another kind of institutional-oriented platform, not as expensive as Bloomberg, but not nearly as many features as Bloomberg has. CQG is much more pure charting system. I incorporate this model into my weekly In the Know Trader written work that subscribers of mine have access to, because I incorporate these models into what we do. And it's not the only model, for sure, it's not the only model we look at, but it's certainly a helpful tool at understanding when I certainly may not want to be playing in the direction of the trend, and certainly may want to go counter trend. So hopefully at this point now, if you've listened to our last 4 weekly webcasts, we've gone through this model pretty well, and you get a good sense of it. And I do this for you so that as a viewer of In the Know Trader webcasts each week through StockCharts.com, as well as subscribers to In the Know Trader, and we put out a tactical trader report every Wednesday night to subscribers. This is one of the key models I use, along with a few others, to better get a handle on the market. So we've got a couple minutes left. We conclude the educational portion, and now let's just take a look at some charts that I want you to see, and kind of my thoughts on things. So here's the, I'll take off some unnecessary stuff. Here's the S&P 500. Here's the all-time high up here that the trend line is starting from. But what I want to do is highlight here, let's see, we have ellipse. So in this area here, notice I have both a aggressive and sequential standard, let's say that again, an aggressive and standard sequential signal come just a few days apart. And it was pretty darn close to the January peak before the market fell. There's a buy signal in here using the aggressive setting. You can see a 9 high, a 9 low. There's a 13 upside exhaustion point here, which worked for a week, but wasn't really the top to the move. But if you see in here, there actually is a aggressive sequential setting just, I don't know, 3 days or so before the all-time high. What has me interested now is that a couple days last week, and let's blow this up, you can see that the two signals came very close to each other, just a couple days apart. So that makes me hesitant to be adding any more exposure on the long side here. And I've told institutional clients in my piece that just came out last night for institutions, because of course yesterday we were on holiday, that I'm not friendly towards additional buying here. I think, I'm not saying the market can't go higher, but there's a lot of risks to keep buying. And then the other chart we're just going to do very quickly is the dollar index. Notice the multiple 13s. We just ran up to a 9 and have stalled. If you're a bear, you've got about as much as you want to see as far as upside exhaustion, anywhere between 97 and 97 and a half on the dollar. So that's it, folks. Another good week. In coming weeks, we're going to have some special guests on from Wall Street that'll give you some very good insights into things that you likely don't get a chance to hear from elsewhere. And I'm Rick Bensignor. Thank you for listening to our In the Know Trader webcast.